Most people are introduced to investing through one dominant idea: growth. Buy assets, wait for appreciation, and someday the portfolio becomes worth more than it was before. The emotional focus stays fixed on future valuation. Higher account balances. Bigger charts. Larger net worth numbers. But eventually, many investors begin discovering a very different question hiding underneath the entire system. Not how much the portfolio is worth, but whether the portfolio can begin supporting life itself. That shift changes everything psychologically, because dividend investing is not purely about ownership growth. It is about transforming capital into recurring cash flow. And once investors begin thinking in terms of cash-producing assets rather than purely speculative appreciation, their relationship with money often changes dramatically. This is why dividend investing attracts such intense emotional fascination. A salary requires continuous labor. Dividend income represents ownership generating cash flow independently of immediate work effort. Even small dividend payments feel psychologically different because they create the sensation that assets themselves are becoming economically productive. At first, this sounds deceptively simple. Buy dividend-paying investments. Accumulate enough shares. Eventually receive enough recurring income to support expenses. But underneath this idea exists an enormous amount of misunderstood mathematics, behavioral psychology, and economic complexity. Because most people fail at dividend investing long before the numbers themselves become the problem. The first mistake is usually emotional impatience. Dividend investing is structurally slow during the early years. Someone beginning with a modest portfolio may receive only small quarterly payments. The income feels insignificant relative to ordinary living expenses. Psychologically, this creates disappointment because the investor imagines passive income as immediate freedom rather than gradual infrastructure building. But dividend systems behave similarly to all compounding systems. Early stages appear weak precisely because the asset base is still small. The future value of recurring investments depends heavily on consistency and duration because compounding allows both capital appreciation and reinvested dividends to accelerate over time. During the beginning phase, contributions dominate progress. Later, reinvestment and portfolio size begin dominating instead. This transition is psychologically difficult because humans naturally think linearly. If someone receives $50 in dividends during the first year, the brain instinctively assumes future progress will remain similarly slow. But exponential systems rarely feel impressive early. Reinvested dividends purchase additional shares. Additional shares generate larger future dividends. Larger dividends purchase even more shares. Gradually the system begins feeding itself. At some point, the investor notices something subtle but important. New dividend income is no longer coming primarily from fresh contributions. It is increasingly being generated by previously accumulated ownership itself. That is the moment the psychology changes. Because ownership begins feeling productive rather than merely theoretical. Historically, this distinction shaped enormous amounts of wealth accumulation. Landowners collected rents. Merchant families earned recurring trade profits. Industrial investors received business distributions. Dividend investing represents a modern financial version of an ancient principle: ownership of productive assets generating recurring economic output. The important detail is that productive ownership changes financial behavior over time. Someone dependent entirely on salary income experiences constant economic interruption. Work stops, income stops. But someone gradually building dividend-producing assets begins separating survival from immediate labor dependency. The transition happens slowly, almost invisibly at first, but psychologically it becomes profound. This is one reason financially resilient people often prioritize cash flow stability over visible status consumption. Dividend income may appear boring externally because the process lacks dramatic excitement. There are no viral overnight success stories. No explosive speculation narratives. No constant stimulation. Instead, the strategy rewards patience, duration, and emotional stability. And modern financial culture often works directly against those traits. Most digital investing environments encourage stimulation. Constant price updates. Trending stocks. Aggressive speculation. Short-term narratives. People become emotionally addicted to volatility because movement itself feels productive. Dividend investing often appears dull by comparison because its power emerges gradually through repetition rather than excitement. This creates a fascinating contradiction. Many investors intellectually understand long-term compounding yet emotionally struggle to tolerate slow visible progress. They abandon stable systems searching for faster outcomes precisely because early compounding stages feel underwhelming. The irony is that dividend investing often becomes more powerful only after surviving its least emotionally rewarding phase. And this is where the mathematics become increasingly important. Many people ask how much money is required to live entirely off dividends. The answer depends less on fantasy numbers and more on cash flow mathematics. Tongue sticking out / times our dividend income depends on portfolio size multiplied by yield. A portfolio generating a 4% annual yield produces approximately $40,000 annually for every $1 million invested. Higher yields may produce more income initially but often carry additional risks including lower growth, business instability, or dividend cuts. This is where unrealistic expectations destroy many investors psychologically. People often imagine living off dividends quickly while underestimating the capital base required for meaningful income generation. A small portfolio cannot realistically produce large sustainable cash flow without excessive risk-taking. And excessive yield chasing frequently leads investors into unstable companies, over-leveraged assets, or temporary income traps. The system punishes impatience repeatedly. Strong dividend investing usually depends on balancing yield, stability, business quality, diversification, and long-term reinvestment discipline. In other words, it behaves more like infrastructure building than speculation. That mindset matters enormously. Someone chasing rapid income may constantly rotate between unstable assets searching for immediate gratification. Someone building long-duration cash flow systems thinks differently. They evaluate sustainability, economic resilience, dividend coverage, business durability, long-term purchasing power after inflation. Because eventually the goal is not simply receiving payments. The goal is preserving financial flexibility across decades. Inflation complicates this further. A dividend income stream that feels sufficient today may lose substantial purchasing power over 20 years if portfolio growth fails to outpace rising costs. This is why many experienced dividend investors prioritize companies capable of increasing distributions gradually over time rather than merely offering the highest current yields. The portfolio must continue evolving economically rather than remaining static. Historically, periods of inflation, recessions, wars, and financial crises repeatedly exposed weak income systems. Companies cut dividends. Asset prices collapsed. Entire industries disappeared. Sustainable cash flow investing therefore depends heavily on resilience rather than optimism alone. This becomes psychologically important because dividend investing only works properly when the investor survives emotionally through volatility. And volatility feels very different once portfolios become large. A person watching a small account fluctuate may feel temporary discomfort. A person depending partially on investment income may experience something deeper, uncertainty about future stability itself. This is why emotional discipline matters so much more than most people expect. Dividend investing is not simply a spreadsheet exercise. It is a long-term behavioral system requiring patience during periods where progress appears slow, markets appear irrational, and future outcomes remain uncertain. The strange part is that this uncertainty never fully disappears, even for experienced investors. There is always economic risk. Interest rate changes. Market cycles. Political instability. Corporate failures. Recessions. Dividend cuts. Financial systems remain deeply interconnected and constantly changing. Yet historically, productive ownership has still remained one of the most effective mechanisms for gradually reducing dependence on direct labor income over long periods. Not perfectly. Not without setbacks. But consistently enough that the principle has survived across centuries of economic change. And perhaps this is the deeper psychological appeal of dividend investing. It represents the possibility that time itself can slowly reduce fragility. Each reinvested payment slightly increases future income capacity. Each year expands productive ownership. Each cycle makes the portfolio marginally more independent from present labor. Eventually the investor realizes the process is not really about chasing passive income fantasies at all. It is about slowly building systems capable of supporting future autonomy. That transformation rarely feels dramatic while it is happening. Most of the time it feels repetitive. Quiet. Even boring. And yet beneath that ordinary repetition, something extremely powerful may be occurring mathematically. Because financial freedom often does not arrive through explosive moments. Sometimes it arrives through cash flow systems built patiently enough that almost nobody notices them growing until the structure has already become substantial.